Investing in stocks is a way to make your money grow over time. By regularly putting money aside to invest, you can see its value multiply over the long term. That's why it's important to begin as soon as you have the money to do so. The longer your time horizon, the better. This video takes you through how much you need, what stocks to choose, and the other basics of investing in stocks you need to get started, all in 10 steps. Whether you have thousands set aside or can invest a more modest $25 a week, you have enough to begin. Step 1. Set clear investment goals. Reflecting on your financial aspirations is the initial step towards building a secure future. Whether you're aiming for short-term milestones like saving for a vacation or long-term objectives such as ensuring a comfortable retirement or funding your child's education, clarity is key. Your goals will naturally evolve with your life stage and ambitions. Younger individuals often prioritize growth and long-term wealth accumulation, while those nearing retirement lean towards income generation and capital preservation. To effectively navigate your financial journey, precision in goal setting is essential. Instead of vague aspirations, articulate specific targets like amassing $500,000 in your retirement fund by age 60. Additionally, determine the timeline for each goal to tailor your investment strategy accordingly. Longer horizons generally allow for less risk exposure. Realistically assess your financial situation, considering savings, income, and available resources. Prioritize your objectives based on importance and urgency, recognizing that financial planning is dynamic and requires periodic reassessment. Life is fluid, and as circumstances change, so will your financial goals. Embrace this evolution, regularly reviewing and adjusting your objectives to align with your evolving aspirations. With a clear vision and adaptable strategy, you can embark on your financial journey, empowered by the potential for future prosperity facilitated by prudent investments and strategic planning. Step 2. Determine how much you can afford to invest. Determining how much you can afford to put in stocks involves carefully and honestly assessing your financial situation. Don't worry if your funds are less than you would wish. Just like you shouldn't berate yourself for not being ready for a race on your first day of training, so too, you're just at the beginning of your investment journey. This is a marathon, not a sprint, and you've got a long way to go. Here are some tips for giving yourself an honest appraisal of how much you can use. Look at your sources of income. Start with your income. In particular, you'll want to see if your employer offers ways for you to invest while gaining tax benefits or with matching funds that will amplify your own contributions. Have an emergency fund. You should have a solid financial foundation before investing, though solid does not mean perfect. Settle on how much you need for emergencies, typically covering major expenses, a few months of mortgage or rental payments, plus your other bills. Snuff out any high-interest debts. Financial advisors also generally suggest making sure you've paid down your debts, especially credit cards and anything else with high interest rates. Any returns you expect from trading stocks are unlikely to make back the cost of the high interest rates accruing each month on your credit card statements. If you still owe on your student loans, look at how much interest you pay. Balance that against the returns you expect by investing in stocks, and choose whether it's better to pay your loans down or invest. Set a budget. Based on your financial assessment thus far, decide how much money you can comfortably put into stocks. This shouldn't dip into any funds you need for expenses now or down the road. Your budget should determine if you are starting with a large lump sum or investing smaller amounts at set times each month or year. Investing in stocks carries risk, and it's important to only invest money you can afford to lose. Never put yourself in a financially vulnerable position for the sake of investing. This is what separates investing from some of the worst forms of gambling. Step 3. Determine your tolerance for risk. Understanding your risk tolerance is pivotal when venturing into investing. It entails assessing your comfort level with the uncertainties inherent in the stock market, a consideration influenced by factors like your life stage, financial objectives, and resilience to potential losses. This evaluation forms the bedrock of your investment strategy, guiding decisions on suitable stocks for your portfolio and how to navigate market fluctuations. Avoid the temptation to veer too far into either recklessness or excessive caution. Instead, align your risk tolerance with your investment goals and preferences. Are you inclined towards stability, or are you open to embracing higher risks for the prospect of greater returns? This introspection lays the groundwork for your investment journey, ensuring it's built on a solid understanding of your risk appetite. Stocks can be categorized based on their risk profiles, offering investors a spectrum of options to match their preferences. Large-cap stocks, representing established companies, typically offer stability. Conversely, small-cap stocks present higher growth potential but carry increased risk. Growth stocks promise rapid gains but entail higher volatility, while value stocks prioritize long-term, stable growth with lower risks. Understanding these distinctions empowers investors to make informed decisions aligned with their risk tolerance and financial objectives, setting a sturdy foundation for their investment endeavors. Step 4. Determine your investing style. Understanding your investing style is crucial for making informed decisions that align with your preferences and goals. Some investors prefer a hands-on approach, conducting research and managing their trades independently. This do-it-yourself (DIY) approach grants full control over investments and is suited for those with a good understanding of the market. Others prefer working with a financial advisor or broker, valuing the personalized guidance and expertise they provide. These professionals offer tailored advice, help select suitable investments, and monitor portfolios, making adjustments when necessary. This approach is ideal for those who prefer a more personalized and collaborative investing experience. Ultimately, the choice between DIY investing and working with a financial advisor depends on your comfort level, expertise, and preferences. While your investing style may evolve over time, starting with an approach that resonates with you is essential for building a successful investment strategy. Step 5. Choose an investment account. When selecting the type of account for your investments, consider your goals, risk tolerance, and desired level of activity. Common options include retirement accounts like employer-sponsored plans, 401k, 403b, 457, offering tax advantages and often employer matching contributions. Individual retirement accounts, IRAs, provide additional tax benefits and flexibility. For taxable brokerage accounts, you have flexibility but lack tax advantages. Individual brokerage accounts offer full control over investments, while joint accounts are shared by multiple individuals, often spouses. Managed accounts provide professional management tailored to your needs. Specialized accounts cater to specific goals with tax advantages. Dividend reinvestment plans automatically reinvest dividends without commissions. Education savings accounts and health savings accounts offer tax benefits for education and medical expenses, respectively. Trust and custody accounts are managed for the benefit of a third party or minors until adulthood. Choose the account type that aligns best with your investment objectives and tax considerations. Step 6. Learn the costs of investing. When choosing a brokerage firm, broker fees are a critical consideration alongside reputation and alignment with your investment goals. Traditionally, brokerages charged fees such as trade commissions, account maintenance fees, and fees for additional services like research or advice. However, the landscape has evolved, with some brokers now offering commission-free trades but compensating with other fees. Trading commissions can range from $2 to $10 per trade, impacting your portfolio's return and available investment funds. Maintenance fees may apply if your account balance falls below a certain threshold, though some fees can be waived. Service fees, like broker-assisted trades or margin trading, are often optional. Subscription-based models are gaining popularity, offering flat monthly or annual fees for access to various services. Account minimums have become less common, with many online brokers eliminating them, making investing more accessible. However, it's essential to assess any minimum requirements alongside transaction and maintenance costs to determine the most cost-effective approach. Step 7. Pick your broker. Brokers can be categorized as either full-service or discount. Full-service brokers offer a wide range of financial services, including tailored advice for various life events like retirement, healthcare, and education. They typically cater to high-net-worth individuals, requiring significant investments. These brokers justify their higher fees with personalized advising and a comprehensive suite of investment products and educational resources. Minimum account sizes can start at $25,000. On the other hand, discount brokers provide tools for self-directed investing, allowing you to select and trade individual investments. Some offer robo-advisory services for automated investing, While they offer fewer services compared to full-service brokers, discount brokers often have lower or no minimum deposit requirements and provide educational materials through their platforms and mobile apps. Step 8. How to fund your stock account. To fund your chosen account, begin by selecting a brokerage that aligns with your investment goals and preferences. Consider factors like fees, available investment options, and platform usability. Next, decide on the account type, cash or margin. Once decided, open your account, providing personal information like your social security number and financial details. Link your bank account to facilitate funding, typically done online through the brokerage's platform. After linking, transfer funds via electronic transfer, wire transfer for faster processing with higher costs, or physical checks. Consider setting up periodic transfers for regular investing. Once funds are verified in your account, start investing in stocks that align with your goals. If you plan to trade frequently, explore brokerage options tailored for cost-conscious traders. Step 9. Pick your stocks. Choosing the right stocks for investment, especially for beginners, can seem daunting. It's essential to prioritize stability, reliability, and steady growth over the allure of quick gains. Blue-chip stocks, known for their stability and strong performance, are a solid starting point, providing a safe harbor during market fluctuations. Dividend-paying stocks offer regular income, which can be reinvested to compound returns over time. Growth stocks, while potentially lucrative, come with higher risk and are best approached with caution, especially in industries with long-term potential. Defensive stocks, resilient during economic downturns, provide a buffer against market volatility. ETFs, offering instant diversification and tracking various indexes or sectors, are a low-cost option for broad exposure to the market. Beginning with a conservative approach lays the foundation for confidence and returns as one progresses in investing knowledge and experience. Step 10. Keep learning about investing in stocks. Investing in stocks is a continuous learning process, with even the most successful investors constantly acquiring new tips and strategies. Staying up to date with the evolving stock market requires revisiting goals, available funds, and investment styles regularly. It's essential to read widely from reputable financial news sources, avoiding promises of easy returns. Utilizing stock simulators can provide valuable practice, while learning about diversification helps spread risk and enhance potential returns. Continuous education empowers investors to make informed decisions and adapt to market changes effectively. How much money do I need to start investing in stocks? The amount needed depends on the brokerage firm and the investments you're interested in. Some online brokerages have no minimum deposit requirements, allowing you to start investing with a small amount of money. However, the price of individual stocks and the minimum investment for certain mutual funds, or ETFs, might require you to start with more of an initial investment. That said, there are many brokerages and investment options now for those starting with less to invest than there were a decade or two ago. Beginners can start investing in stocks with a relatively small amount of money. You'll have to do your homework to determine your investment goals, risk tolerance, and the cost of investing in stocks and mutual funds. You'll also need to research brokers and their fees to find the one that best fits your investment style and goals. Once you do, you'll be well positioned to take advantage of the potential stocks have to reward you financially in the coming years. Thank you for watching. Don't forget to like and subscribe to our channel for more videos like this in the future.